The crypto market has been one of the worst performing assets this year. Over the past 10 months, it's gained less than 3%, a number that's proven quite painful considering the level of risk crypto investors take on. For comparison, gold has risen by 55%, the US stock market is up 12%, and even treasury bonds have delivered 6%. To make things worse, a growing number of investors and media outlets now believe that the crypto bull run has ended, with the market poised for significant more downside from here. And that's actually a fair argument to make today. After all, we've just witnessed a massive leverage flush in the crypto markets. Over 1.4 million positions were liquidated, as we can see through this chart showing the number of total liquidations. This wiped out over $19 billion worth of leveraged trades, making it the biggest 24-hour liquidation ever recorded. And it forced over 1.6 million leveraged traders out of the market. As a result, crypto sentiment has fallen to levels that are associated with extreme fear. This is some of the lowest levels we've seen since this bull market began in late 2022. But the scale of this liquidation did more than just shake out retail speculation. We can see that through this chart showing Bitcoin's average leverage order size. Each bubble represents clusters of leveraged positions, with green and yellow representing orders by large players, and red showing smaller retail trades. Every sustained rally since 2024 consistently saw large green and yellow bubbles, indicating strong participation from high net worth traders. But following the recent liquidation, those large clusters have completely disappeared. In other words, this flush cleared out not only retail traders, but also a large portion of the bigger players who have been driving much of the leverage earlier this year. What remains now are mostly small red dots, so retail-sized orders. As a result, the average leverage order has dropped from $10,000 earlier this year to just $2,000 today. That's an 80% collapse, showing how dramatically speculative capital has pulled back from the market. And that's not necessarily a good thing. Without larger players making directional bets, the market can often struggle to generate momentum if there's not enough underlying demand. This is what happened back in early 2025, for instance. We primarily saw participation from retail traders who were unable to push the market higher. But despite today's demand weakness from the leverage market, there are still other key sources of demand we need to consider. And as you'll see later in this video, one of them could soon become a major catalyst for the crypto market. There are three other sources we need to look at. The first is the ETF flows for Bitcoin and Ethereum, since those are the only two tokens with listed funds. From early 2025 until April, these funds were seeing steady outflows. During that same period, the broader crypto market fell by around 35%, showing how closely price tracks institutional flows. Then, from April through July, there were large inflows into these funds. That coincided with a 65% rally across the market. But since August, we've seen a mix of inflows and outflows, leading to the crypto market moving sideways. So ETF flows are signaling a yellow light at best today. The second source is digital asset treasury companies. These are public companies that hold crypto tokens on their balance sheet as part of their reserve strategy. This chart shows the percentage of total supply held by these treasury companies. Since October 2024, the share of Bitcoin held by these firms has climbed from around 1.5% to over 4% today. Now, if we add the data for altcoins like Ethereum and Solana, we see that public companies held no supply of these assets until April of 2025. But as regulatory clarity improved earlier this year, it sparked a wave of treasury buying. The share of supply held by these treasury companies has now reached 3.5% for Ethereum and 3% for Solana. In fact, we're also starting to see new treasury adopters emerge for other major altcoins like Avalanche, Ton, and Litecoin, signaling that confidence is broadening in the crypto market. This kind of demand from treasury companies creates a structural form of buying pressure. In other words, when large corporations allocate part of their balance sheets to digital assets, it effectively locks up supply, reducing the available supply and magnifying the impact of future inflows that follow. So treasury companies are signaling a strong green light today. The third key source is what we can call upcoming demand. This is something a lot of investors are not taking into account right now, but one that could have a significant influence on the crypto market. This chart shows that over 90 crypto-focused funds are currently awaiting approval in the US. Among them, Solana and XRP lead the list with over 8 pending applications for each. Altogether, this chart shows that these funds could soon open the door to billions of dollars in new institutional demand for a lot of tokens in the crypto market. However, progress has been temporarily delayed due to the ongoing government shutdown, which has paused the approval approval process. Once operations resumes, though, these applications are expected to move quickly through the review process. According to a senior analyst at Bloomberg, many of these approvals are as good as guaranteed. That's because regulators have already established frameworks and precedents through Bitcoin and Ethereum funds, making it easier for the next wave of crypto products to pass through once the process restarts. While we don't believe there are ever any guarantees in the markets, we do think the odds of these approvals are quite high once the US government reopens. So the upcoming demand catalyst is signaling a green light for now, of course, with the risk of turning yellow or even red if the application for these funds are rejected after the US government reopens. That means, despite the loss of demand from large leverage players, we still have average ETF flows, but very strong demand from digital asset treasury companies, with the potential for even more once additional altcoin-focused funds are approved. So the crypto market could be driven by organic demand from here, rather than leveraged speculation, which we think is actually a healthier foundation for the overall crypto market. And this is happening while the macro backdrop remains extremely constructive for risk assets, something that we covered extensively in our recent crypto video. So even though the crypto market has severely underperformed this year, we don't believe it's entering a bear market just yet. In fact, if we zoom out to the beginning of this bull run, the crypto market has actually returned at least 3 times more than the other assets. In our view, what we're seeing now is likely a period of consolidation within a larger uptrend. We also managed to completely sidestep the recent liquidations, as our risk management framework triggered a sell signal before the event. For now, we're remaining patient and waiting for the technical structure to improve before turning more aggressive again. Our trading approach has helped us secure multiple double-digit wins, all while keeping most of our losses limited to around 5%. We take our clients step by step by sharing our exact trade setups in real time and our trading strategy through 3 weekly premium videos. If you want to follow all our moves in real time, make sure to join us using the link below.